welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. Stocks are lower ahead of the closing bell as investors await another round of critical earnings from big tech.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
When you look at underlying demand, consumer spending growth, that was still pretty solid. So it's going to be interesting to see what happens over the next couple of quarters and whether that solid demand holds up or whether we start to see consumers pull back, businesses pull back because of tariffs. But I think overall, this is indicating that tariffs are having an impact on the economy, that it's been negative so far in 2025, and they're likely to remain negative in through the rest of this year.
Tariffs are changing every day. Look at Mary Barra. You know, one day it's a big tariff on automobiles. Next day, well, maybe we'll hold off on tariffs on aluminum and steel. So how do you project your costs? How can you really calculate what it's going to be? And so I think that's why people are withdrawing guidance.
You know, if you look at our results, what I'm seeing actually is a step up in transactions as it relates to our business in the U.S. We had our best quarter as it relates to sales comp in the last 5 quarters. And so we're continuing to see progress in the Starbucks business with customers, and that's going to continue to be the case.
We got 1 hour to go until the market close. Taking a look at the major averages here, we are pairing losses, some might say. You just said to me during the break. The Dow earlier today was down more than 700 points. Now it's still down, but it's down a little more than 200 points, about 0.5%. The S&P 500 at the lows of the day was off by more than 2.25%, now off about 0.75%, and the Nasdaq off about 1% after falling more steeply earlier in the session. A lot for investors to weigh today, and that's before we even get the earnings after the bell, but we did have some pretty significant economic data.
Yeah, it's been a volatile session. So we get the report, shows GDP shrank, and we took a sharp leg lower on that. But then we started sort of debating that, discussing that, Julie, and folks were thinking through kind of the puts and takes of that print. And there were important takes, a lot of front loading to get at the tariffs. Government spending did fall. That certainly got some attention and headlines. But then other economic data was rolling in. In March, consumer spending jumped. You saw an important inflation gauge decelerate. So a lot of economic data points added up. Yes, we're in the red, but off the lows here.
Yes, exactly. One other thing to mention, ADP coming in with smaller job gains than had anticipated. So we'll see if that gets verified by Friday's jobs report. So taking a look here at the NASDAQ 100 heat map. We have earnings after the close from Meta, which is down more than 2% today. Interesting to see that kind of action in the print. To be sure, just to put this in perspective, year to date, it has actually performed better than the other Mag 7 names. It's down 7.5%, but that drop is smaller than we've seen from its peers. And then Microsoft, of course, is the other name that's reporting. It is down 7% as well. So it also hasn't done terribly year to date, all things being equal, so in other words, things have not been great year to date, but some of these guys have done less poorly than others.
And it gets back to the GDP print, because I think you see that, Julie, and to the extent that the investors start thinking, okay, economy's slowing. We've had a number of economists come on the show and tell us they think the odds of a recession coming up. So then investors think, okay, what in that environment, what does that mean for online ad spending for Meta? What does it mean for enterprise spending for Microsoft?
Right. I mean, and we should mention Meta also falling after we got Snap numbers that did show some chinks in the armor of advertising. And then sector-wise, looking here, we got consumer staples and healthcare that is up. Energy pretty deeply in the red here. And as our Ines Ferre reported, we saw the worst month for oil prices that we've seen in quite some time. And so energy also taking a hit as part of that. Well, of course, Wall Street's attention will turn to earnings from 2 major tech giants after the bell today. Yahoo Finance's Dan Howley here with what to expect from Meta and Microsoft this afternoon. Hey, Dan.
That's right, Julie. We're expecting both of those companies to report, and a lot of kind of the action around them will be based on forward-looking guidance and what tariffs mean for that. So let's just quickly go over the numbers that are expected for the current quarter. For Q1, Meta's looking at adjusted EPS of $5.34 on revenue of $41.3 billion. Microsoft, they're expecting adjusted EPS of $3.21 on revenue of $68.4 billion. But let's just break down what investors and Wall Street are going to be looking at more broadly. From Meta, it comes down to if ad sales going forward, or perhaps in this current quarter, have been impacted by a tariff-induced slowdown. Advertisers perhaps thinking to take a step back, waiting for all this economic uncertainty to kind of flush itself out, and then go back to spending on ads. Obviously, ad spending is one of the first things that gets chopped from budgets during times of uncertainty, and so you would imagine that could impact them in Q1 if they were looking forward and saying, okay, we know that these tariffs are coming, let's prepare ourselves, or it could start showing up in the coming quarters. And then after that, AI spending, obviously they're among the companies spending billions of dollars on AI. Where does that shake out as far as revenue? Now, we've talked about in the past how Meta seems better aligned when it comes to spending, to getting revenue on that, the returns on those investments, simply because they don't have to worry about cloud. It's all about advertising. The better that they can optimize for advertising, the better they can serve up advertisers with the capabilities to use generative AI for ads, the more they're going to pull in. And then finally, Reality Labs losses. This is something that we always talk about just because, look, it's not making money. It loses by the billions. We want to see what's going on there. And then on the Microsoft side of things, we want to talk about AI cloud sales. That's always kind of the conversation similar to what I mentioned with Meta and AI spending. But for Microsoft, like Google, like Amazon, it's kind of show me the money when it comes to how much they're actually investing and then the return on that investment, whether companies, enterprises, consumers are really buying up that AI, and if it's evening out to or exceeding what they're spending. Beyond that, forward-looking guidance, obviously, for AI sales. Some of the conversations from analysts of late have been about whether or not these companies are pulling back, enterprises are pulling back on future AI spending just because of, again, that tariff uncertainty. And then PC sales. This is something that, obviously isn't the big breadwinner for Microsoft, but Windows 10 is going to sunset in October. The idea is that people are going to go out and buy PCs, but if you look at what Intel said during its most recent earnings, people aren't buying those brand new AI PCs. They're buying PCs with older chips, and so there's a backlog of those older chips right now. So we'll have to see what that means for Microsoft and whether or not people are buying computers at this point. They could have gone ahead and did the pull forward that Intel had seen because of the fear of tariffs. Obviously, President Trump now exempting computers, but they've made clear that they're going to do something in the future on computers when it comes to semiconductor tariffs. We'll just have to see. So a lot of kind of future thinking when it comes to these earnings. Obviously, the current quarter earnings results matter, but I think it's more about, hey, what do you guys know that's coming? What do you think is coming, and how are you preparing for it?
How are you positioning? On Microsoft, Dan, what's the street expecting for Azure? What are you expecting?
So for Azure, they're expecting revenue from AI to come in at around 15.6%, I believe was the number. That would obviously be a jump. It would be the biggest jump since I think 4 quarters ago, something along those lines, 5 quarters maybe. They're expecting that to contribute significantly to it. Obviously, that is the big kind of go-to. They usually report commercial cloud spending and AI, but Azure is at the intersection of all that and the main piece. And so as long as that performs well for the quarter, Microsoft generally performs well. If they miss, people start to freak out. As I said, there could be a pull forward of companies saying, let's just start getting everything set for tariffs. Or it could have been the opposite, where they're saying, okay, tariffs are coming, let's start pulling back now and prepare ourselves.
Yeah, Microsoft CFO Amy Hood, as you know, very well respected on the street. Very interested to see what she says about that forecast, that guide. We shall see. Dan, thank you. Appreciate it. Stocks lower ahead of the closing bell as investors digest another round of economic data and get ready for some crucial earnings reports. For more on the latest market moves and what's next for investors, let's welcome in Michael Kantrowitz, Hyperscaler Chief Investment Strategist. Michael, it is good to see you as always. So, we had another volatile day here today, Michael. You say your advice to clients is the best way to stay positioned right now for investors, Michael, is you say maintain a quality bias. Walk us through what you mean by that broadly, Michael. When you're screening for quality, what does that mean?
Sure. It's generally companies with better or superior fundamentals relative to their peers. So looking for companies within a sector, whether it be tech or industrials or consumer discretionary, that had better fundamentals coming into this backdrop. I would say generally that tends to be larger companies in the upper mid cap and large cap space. Also companies that are generating free cash flow, as well as those that have positive relative earnings revisions. So we're really looking for companies that have been doing well on a relative basis, fundamentally coming into this tariff scare. And we think that will be the best place to be having a balanced portfolio.
Well, and I guess that implies that things are not going to change much, Mike, right? Like I've been crunching the numbers on these first 100 days of the Trump presidency. You got the S&P off something like 7%, not including what we're seeing today. Basically everything is negative, from Mag 7 to treasuries for that matter, to Bitcoin. When you're talking about this quality bias, are you assuming that things are going to kind of stay the same here in terms of the backdrop? And if so, what is that going to mean for the broader markets?
Sure. Yeah, I think there's, oversimplifying it, there's three scenarios. There's the backdrop where tariffs just go, largely go away, and we go back to a world that was a pre-tariff environment. Very unlikely, but that would certainly be a backdrop where I think at least initially equities would very positively respond. We've seen from the lows in the market earlier this month, markets rebound every time Trump says something positive and he rolls some item or country's tariffs backward. I don't think that's very likely. We believe tariffs are here to stay, just not as high as what was announced earlier this month. The other extreme scenario is that tariff levels go back up from where they are, so things escalate from the past 3 weeks de-escalation, and the global economy falls into a recession. We think those odds are also low. So we do think that we are stuck with the highest levels of tariffs in decades, and we've just really begun to see that reflected in the economy, in earnings, and I'm not so sure the market's able to fully digest that yet because the data really haven't shown up.
Michael, let's talk more about earnings. You got some big names after the bell today. Meta, Microsoft. I'm just curious, high level, your thoughts on this earnings season, Michael. What do you make of what you've heard so far?
Yeah, so far earnings have come in actually slightly better than expected to date. And I think that's somewhat a function of the estimates being slashed quite a bit coming into this earnings season with the downturn in the market and high levels of uncertainty. And also we've seen a tremendous amount of pull forward in consumer demand and business demand in the first quarter, which ironically led to slower growth because we imported so much when you look at the GDP numbers. So I think some of that's flowing through and creating some upside numbers. Now, you're not seeing that being reflected in Q2, Q3, or Q4 estimates. So it does suggest that it's really kind of a one-off and not a better than expected environment. So we do think that will really continue through Q1. Again, Q1, most of this tariff noise in the market, from most of the tariff impact from the market really and the economy hasn't shown up yet.
When do you think it is going to show up, Mike? And what do you think the reaction is going to be? Or do you think some of it, has any of it been priced in yet? Or do you think that there is more downside when we get sort of the confirmation of what we think is happening?
Sure. Well, I would say, and I hate to say this answer, but it depends, because I still very much believe that the primary driver of equities right now is going to be all these headlines coming out of Washington. And depending on the incremental change in tariff policies, that could keep the market somewhat cushioned. Yes, I do think there's a worse data to come. Yes, I think the Fed will start getting more dovish once we start seeing softer employment. We did see a soft ADP report today. I don't expect a big collapse in employment imminently, but we do expect further softening, and that should open up the door wider for the Fed to cut. So that could also cushion the market again somewhat. So for now, I think that we're stuck in a range between 5,200 and 5,600 in the S&P 500, and it's really going to be several months, a couple quarters before we really see a broad impact from this. So we've just begun to see the data show up, and it's mostly been in sentiment data and surveys. The negative impact hasn't really shown up in much of the hard data quite yet.
You mentioned the Fed there, Michael. I'm just curious, when you saw that economic data this morning, did you think, okay, it's perhaps the odds just went up that the Fed's going to act sooner rather than later?
Again, incrementally. I don't think it was a massive game changer, but falling JOLTS data from yesterday and weaker ADP data today, all of that is bond bullish, and you're seeing, we've seen the 2-year yield rally quite a bit. The 10 years back down to 4.15 or so. So we're seeing a rally in the 10-year as well, and I think that's the market paying more attention, or perhaps worrying more about the growth slowdown, and particularly soft employment data is extremely bond bullish, and we do remain bond bullish in this backdrop.
And as I hear you talk about all of these things that are potential, sort of relief levers in the market, it doesn't sound like you think stocks are going to go up by that much. You keep using the word cushion. It'll just kind of keep things from going down more. But I am curious about one other potential policy catalyst, and that's this potential tax bill, right? And I wonder if that will give more room for actual upside rather than just sort of downside protection. And if so, what would have to be in there beyond just an extension of the tax cuts? Would that alone do it?
Well, I think, yes, getting it passed will certainly be a positive. And I think that's part of perhaps the administration's strategy, is to make the implied tariff revenue as high as possible in order to get more of what they want in that tax bill, which seems to be likely that it will be passed early this summer. So I do think that's a positive. President Trump has mentioned a whole bunch of other incremental cuts, such as tips and expensing of interest on automobiles. I'm not so sure we're going to get a huge tax cut for everyone making. I think the latest was $200,000, but it could be floated, but we'll see. So that I think will be viewed more positively, and perhaps that's when we really see some of the tariff issues start to ease even further, because I think once they get that passed, I think getting it passed is a main goal of keeping these revenues implied from tariffs high.
All right, thanks for being here. Appreciate it. We'll see what ends up happening. Thanks. We're just getting started here on Market Domination. Coming up, President Donald Trump set to finish his first 100 days in office today. We'll take a look back and break down what is next. Plus, shares of Nvidia taking a hit today following a bearish analyst call. We'll check in on the chip giant later in the hour. And then after the close of bell, it's another round of earnings results. We'll get you the latest numbers and instant analyst reaction for Meta, Microsoft, and more. Stick around. Much more Market Domination still to come. We're hitting the 100-day mark of Trump 2.0. The market's whipsawing a lot over that time frame, and new data rolling in this morning, not adding much relief to the economic landscape. For more, we're bringing in Betsy Stevenson, professor of public policy and economics at the University of Michigan Gerald R. Ford School, and former economic advisor in the Obama administration. Betsy, it's always good to get some time with you. Obviously, the GDP data this morning kind of skewed by the rush of imports as people tried to get ahead of the worst of the tariff impact. What are you watching most closely now to see whether the U.S. economy is going to turn more decidedly in a recessionary direction?
Well, let's start with why the Q1 GDP report is just really, I would describe as impossible to read right now. Is it what you saw were companies that are looking at a world that's so highly uncertain right now that they just don't know what the price of their inputs are going to be over the next 3 months. And so what they did was to give themselves as much certainty as they could, they got ahead in inventories. And so trying to figure out where the economy is going is trying to parse, how much of this behavior, which was about trying to get ahead in inventories and give themselves some stability, which I think, that's good. They're going to have a few months of being like, okay, we know what's going to happen. What happens after that's really going to depend on what the Trump administration does. And so I don't think there's a lot of signs in that report about whether we're headed to a recession or not. I know that it's a negative number, and that caused everybody to gasp. What if next month is a negative number? Aren't we in a recession? Not necessarily. And we may even see Q1 revised to be, say, a 0. So the final report's not out on that. What we know, the only thing we know for sure is there's a lot of chaos in it, and what we can say concretely is it is clear that businesses' attention and resources have been diverted from trying to think about how to grow their company to how to preserve their company in a chaotic world.
Well, and what was interesting to me in particular in the report, leaving aside the exports thing, was spending, right? Consumer spending, which was still positive, I think 1.8%, but it was a slowdown from the fourth quarter. But then you got, as part of this morning's PCE report as well, personal spending up 0.7%, which was, or on a real basis, same, 0.7%. So is that encouraging?
I think that, again, it's really about parsing out what are they spending on, how much of that is spending on domestically sourced goods and services versus foreign goods and services. A lot of people get confused about the fact that we're subtracting off imports, and they say, oh, the number's negative because we're subtracting off imports. No, imports goes in as a 0 because we add them in as a thing you're purchasing, whether you're a consumer or a business, but we don't want to count them because we're only trying to, gross domestic product is what we made in the country. So we subtract it off because we'd added it in. So that doesn't tell us, why we have such a slowdown. As you pointed out, the overall top line number, or even if we're looking at consumers, is a little bit slower. But then there are some things in there that look like the underlying pace of things is just the same as it's been. And look, that's my sense, is the economy was strong in December. It was strong in 2024. It was strong in January. It's strong, and we're lucky it's so strong because it is in a storm right now, and it's weathering that storm the best it can. And so when you're looking at that data, what you're seeing is consumers and businesses trying to weather a storm, and luckily they have a very, very strong boat for that storm because it's a strong economy. And I think that those underlying fundamentals are still there. I'll just cut to the chase. If I was the Fed, this wouldn't be moving me yet, because they're still worried about the price increases, and there's some evidence of inflationary pressure there as well. So you've got the price increase worries, you've got the slowdown worries, and we're all just going to have to wait and see what April and May bring.
Betsy, I want to get your thoughts on the labor market as well. It has proven resilient, Betsy. We got ADP today. That was weak relative to expectations. Government jobs report on Friday. I'm curious what you expect to hear on Friday, Betsy, and then how you try to think through how our labor market could evolve over 2025.
So keep in mind that if you really see the labor market getting hammered, we're already in trouble. Like, we're in a recession. So I don't think we're in a recession right now. And I don't think you're going to see some horrible jobs report. ADP and the employment report don't always match. We might see a slowdown, but we're still going to, see reasonably good growth in jobs. And I think if you take a look at the numbers we do have, which is what happened in March, the JOLTS number, what we see is the early signs of a labor market slowing down. So job openings came down, but there was no real slowdown in hiring in March. What worried me more was there was actually a reduction in separations. You might say that's great, companies aren't letting people go, but it's also that people aren't seeing those job openings, so they're not quitting and looking for that better opportunity. So what we see happen in the labor market first is a slowdown in the dynamism. So there's less churning. People say, whoa, we're in a tough time. I want to stay in my current job. It's a bad time to quit. And then you also see companies thinking, maybe I'll wait before I hire someone new. And so it's like a game of musical chairs where you don't have to get up if you have a seat, but you're in trouble if you don't have one because there's not a lot of new chairs that are going to be becoming available.
Yeah, that's a really interesting point, Betsy. The other thing I wanted to ask you about is, we here in financial media talk a lot about the tariffs, right? People in markets talk tariffs. But as we are here at this 100-day milestone, I'm curious how you're thinking about the economic impact of some of the other policies that we don't talk about as much. Things like cuts to medical research, for example, or some of the immigration follow through. How are you seeing that both short and long term have an economic impact?
First of all, what I see is that the tariff stuff is what's resonating with consumers. And so that tells us a lot about why we're spending so much time focusing on it. It's not just financial markets. I know financial markets care a lot about the tariffs, but it turns out, mom and pop on the street do as well. And, President Trump said today, maybe your kids aren't going to get as many toys at Christmas. And I think for a lot of families, that's like, wait, what? So they're a little worried about them. And I think it's going to take a lot more for things like the cuts in research to break through. They are absolutely going to slow, some parts of the economy, the research parts, because they're not going to be able to afford to hire the people to do research jobs. And you're going to see some of those jobs leave the United States. That's going to be one aspect. And then as they leave the U.S., and that's immigrants were discouraging people from coming over to the United States to study. And so that's going to slow our educational institutions' growth. That's not just about, big public universities like mine at the University of Michigan, but, there's a lot of private sector involvement in education, and they're just going to have fewer students to serve. So all of that, I think it's small, but it's building. And that's going to be a drag on the economy. And the reason you're focusing on tariffs is because that's a huge drag on the private sector. And the Trump administration, the part of the administration that's making all of those cuts, I think is hoping that the private sector is going to pick up that drag. But if the private sector is having its own drag, it certainly can't offset the drag from things like cuts to research. And of course, even more problematically, as we cut research, it slows economic growth in the long run. But those pains can take, honestly, decades to unfold.
Whereas those dolls at Christmas, that issue might be coming sooner, Betsy. Thank you so much for being here. Appreciate it. Good to talk to you.
Good to talk to you.
Now time for some of today's trending tickers. We're checking in on shares of Etsy, GE Healthcare, and Seagate Technology. They're all in focus following earnings results. Let's start with Etsy. It's sinking today after providing guidance that disappointed some investors. Etsy CFO Lanny Baker saying Etsy is staying nimble in the face of uncertainty around the tariff announcements and the fluid state of consumer confidence in our core markets. A lot of the numbers here from Etsy actually looked pretty decent here. So on the face of it, and initially we were seeing the stock actually pick up a little bit, but EBITDA margin in the second quarter expected to be below estimates, and the company is now seeing 4 straight quarters of declines in active sellers.
Yeah, it's just reading through some of the commentary here. Citi analysts cited as saying results better than feared, but shares likely to be range bound until more clarity on GMS directions. Citi neutral on that name, and so right now most on the street.
Yeah, GMS, gross merchandise sales, the value of all the stuff that's sold via Etsy. And by the way, that fell by 6.5%, and the company says that should decline this quarter at a rate similar or maybe a little bit better than that 6.5% rate.
All right, we'll keep watching. Shares of GE Healthcare Technologies getting a boost today following a double beat on their first quarter earnings report. The company also reduced its forecast of full year 2025 adjusted earnings about 15% for its prior view, but seems investors may have been pricing in tariff concerns. So this one looks like a beat, did cut, but the street seems to think, just reading through some of the commentary, Drew, like that was sort of a conservative move by the company.
Yeah, I found this really interesting. So the company actually slashed its earnings estimates pretty dramatically. Now it's seeing the upper end of its full year forecast at 410. The lower end of it had been 461. But there was one note that really stood out to me. The company is assuming that reciprocal tariffs could return to those April 2nd levels when the 90-day pause expires. So that's, in other words, it is sort of pricing in and assuming a worst case tariff scenario, and also that the China tariffs are not going to come down at all before that point in time. So then it makes sense why these analysts are saying they're being very conservative with their guidance.
Yeah, JP Morgan, which is neutral on this one, says with the full effect from tariffs baked into the numbers, they say, we think this could be a clearing event for the stock that allows the focus to return to fundamentals, especially, they note, following a good Q1.
And then finally, let's get to Seagate Technology. It is higher today. The data storage company reporting fiscal third quarter earnings that did top expectations. It also issued a forecast for the fourth quarter that was better than expected. Krish Sankar, who we know over at TD Cowen, said the quarter was flawless.
Nice, Krish.
You don't hear too many comments like that, especially this earnings season here. And also the company's forecast was above estimates, which is not something we've been seeing a lot of.
Citi has a buy here, results above expectations, better sales, gross margins, strong demand. Guide was better, they said, than our estimates. End demand indicators intact. They raised estimates. They highlight May 22nd Analyst Day as the next catalyst, so mark that on your calendar.
Leave it down.
All right, it's a crucial moment for AI chipmaker Nvidia. Stay with us after the break. We're going to have deep insight into what's moving the stock today and analysis looking forward, all that and more coming up. Nvidia given a rare sell rating, Seaport Research initiating coverage on the stock with a bearish call as it highlights that upside appears to be fully understood and largely priced into the stock. So Seaport here initiating coverage, Julie, on the semis. This is just a broader note, but they do include here a sell on Nvidia. And among their reasons they told their clients, AI priced in for now, they say. They talk about how its prospects are well understood, largely priced in. They talk about mounting questions as to the utility of AI. They also call out competition. They say from NVIDIA's customers, they stray strong momentum behind the cloud giant's internal NVIDIA alternatives.
And what's so striking about this is the only sell on Nvidia.
Is that true?
From Wall Street.
Yeah,
I believe it is the only one. There are some hold ratings, but there aren't really any other sell ratings. So this is really standing up. There you go.
Yeah.
70 buys, 9 holds, only 1 sell. So this really stands out in terms of its commentary, and that it's not just going to a hold, it is going to a sell. As we know, we don't get NVIDIA earnings until later than the rest of the group, about a month from now. We did hear from Super Microcomputer, which came out with some preliminary results that were weak, and so there is some assuming read-through that the market is assuming, at least, from those results.
By the way, what do they like? Also important,
Yes,
Broadcom. Broadcom is a buy, they say.
Right.
AI not priced in there.
Well, because they think that more companies are going to get Broadcom to make custom chips for them. And so that's part of that.
So sell Jensen Huang, buy Hock Tan.
Ooh, interesting. I like it when you put it like that. All right. The Trump administration spurring fears of tightening chip trade rules as well. The potential changes adding to those other mounting risks for NVIDIA. The chip maker's also facing pressure tied to customer Super Microcomputer as it slashed its revenue and profit outlook for the third quarter. Here to decode what's ahead for semiconductors, including NVIDIA, we've got KeyBank Capital Markets equity research analyst John Vinh. John, it is always great to catch up with you. And I want to get your take first on this view of NVIDIA here, that we're going to continue to see this migration to more customized chips or contract-made chips from the likes of Broadcom. And it does seem like some of the sentiment is piling up against NVIDIA here.
Yeah, I think that view is a little bit more premature at this point in time. We think we are still in the very early stages of generative AI. You know, the view that it's a zero-sum game between whether someone's going to go with a custom AI chip or with a merchant GPU from NVIDIA. I don't think we're quite there yet. If the market starts to mature and we're in the latter innings, then you've got to be more mindful about what that split looks like. But at this point, you know, it's very early stages, and NVIDIA is so far ahead of the competition. You know, Broadcom does have a flagship customer in Google's TPU, which is a very competitive chip. But outside of the Google TPU, there are limited proof points out there of another customer having a competitive chip to what NVIDIA offers or what Google makes with Broadcom.
John, there was another headline that certainly got attention. I want your take on this one. Reuters reported, and this was late yesterday, that Trump officials are working to change a Biden-era AI trade rule capping access to US AI chips, potentially making it stricter. I'm wondering, John, listen, you're an Nvidia investor, you read that, what should you make of a headline like that?
Yeah, I think there's certainly a lot of angst around the quote unquote the diffusion rule, right? It's supposed to go into effect in mid-May. I want to say May 17th, May 18th, right? And I think there is some rightfully consternation around it, because what it is in effect trying to limit is the ability or of the US's competitors or rivals to get access to Nvidia's GPUs, right? Obviously we've got a straight direct ban on China, but we also know that there is a gray market in which our competitors, including Chinese constituents, are able to get access to Nvidia GPUs through other gray market channels by importing them through other countries. So yeah, I think there is some angst and consternation. In terms of how it kind of plays out is unclear, right? I mean, I'm seeing the same headlines as you that they're reconsidering it, but we'll have to see how it plays out. But it is certainly a concern and a little bit of a near-term overhang on Nvidia stock at this point.
So John, bottom line, is Nvidia still a buy or even more of a buy at these levels after the declines it's seen?
I certainly believe so. The valuation is not fully pricing anything in. I think if you look at out your numbers, it's trading at less than 20 times earnings historically. I mean, Nvidia is traded, 35, 45 times, 35 to 40 times, and it's trading at a pretty significant discount. You've got the China chip ban. So we've taken, $12 billion out of our numbers this year. So you could argue that a lot of that is de-risked. So at these levels, it's not pricing in a whole lot. And we still believe that they are significantly ahead of their competitors at this point. With this new platform that they're rolling out, GB200 NVL72, they have certainly put a lot of room between themselves and their nearest competitors.
John, one issue I know front and center for Nvidia investors too was this idea, this concern that the hyperscalers, the cloud giants, were going to start slowing down that AI spending, John. Now, Alphabet reiterated its CapEx guide. Today, after the bell, we're going to hear from Microsoft. I'm just curious how you're thinking through that dynamic.
Yeah, we're not picking up any signs that the major hyperscalers are kind of slowing down. Obviously, there's a lot of consternation about what Microsoft's view is going into next year. We'll have to see what they have to say. But in the near to medium term, I am not seeing any signs of any sort of slowdown at this point. Maybe there's a few issues that we're picking up on the supply side related to Nvidia, but the demand side looks pretty strong at this point.
John, besides Nvidia, so unless we let it dominate the conversation like it typically does, what else are you liking within chips right now? Where are you seeing sort of the best opportunities ex Nvidia?
Yeah, I mean, on the AI side, we also really like Broadcom. Like you said, we don't think it's zero sum. They're obviously have a flagship customer in Google's TPU, and they've got several others in the pipeline that are going to ramp up in the next several years. They're a very strong position in AI. And then more broadly in analog, we like analog devices and Texas Instruments. We think they're well diversified. They don't have outsized exposure to the automotive market, which is under a lot of pressure right now. They're further through the cycle, and they're well positioned for a recovery here in the second half if we do have some sort of resolution on the tariff side.
John, thank you. Good to see you as always. Appreciate it.
Thank you.
More companies are sending warnings this earnings season as they continue to navigate trade war turmoil. Stay with us. You'll want to hear all about the firms pulling or cutting forecasts and what that means for your investments. All that and more coming up. We continue to be on tariff watch this earnings season, so let's round up some of the latest that we are seeing, the latest commentary. Another automaker changing its outlook today. That is Stellantis, which is suspending its 2025 financial guidance. The company citing, quote, tariff-related uncertainties for that suspension. The global head of investor relations at Stellantis avoiding multiple questions about tariffs on the earnings call, but he did say, quote, in terms of what's likely to happen over time related to the tariffs, that's outside the scope of this call. We'll also be keeping a close eye on Ford. That company will report its first quarter earnings on Monday. GE Healthcare also mentioning tariffs on its earnings call. The company cutting guidance this morning amid the global trade environment. The CEO saying on the call that a conservative estimate on the total U.S.-China tariff impact is about 75%. And tariffs in focus with Stanley Black Decker as well. CEO Don Allen saying the company is exploring all options to mitigate the tariff impact. Allen elaborating further on the earnings call, saying, quote, while we don't know the full picture of how tariffs will impact the U.S. economy or demand in our categories, we are preparing ourselves for multiple demand scenarios this year, and they are planning to raise some prices.
All right, shares of the Scotts Miracle-Gro company fallen today. That's following mixed results on their second quarter earnings. We're joined now by Jim Hagedorn, Scotts Miracle-Gro company chairman and CEO. Great to see you, sir, here on set.
Hi.
Let's get right to this report.
I don't
Jim.
think it was a mixed, report.
Well, I want you to respond to this because it's not. We're under some pressure here. It did look like you reported Q2 sales that maybe missed consensus, Jim, but I want you to walk us through this report. I want you to explain to us what you're seeing in the business.
Business is fantastic. I mean, our point of sale, which is our sales to consumer at retail, are, I think right now, I think we reported for the first half like plus 12.1. Today, it's over 14% ahead of last year in actual POS units to consumer. We affirmed guidance on sales. And so I don't know what, I can either blame the street for completely not getting it or say I must be the worst storyteller in the world, where we reaffirm guidance. We are beating all of our financial metrics. Sales were, if you exclude some one-time sales as we sold some excess inventory last year and discontinued one business, sales were flat. But the first half of the year is nothing but load in to the retailers. And so what really matters is replenishment. 60% of our sales happen in the second half of the year. And so, just in the last 2 days, like the POS that I got up, our complete sales data was up, I don't know, almost 1.5 points just in 2 days. This is the weather that you guys are complaining about with allergies.
Well, it's a blessing and a curse.
No, exactly. But it is gardening season hardcore, and business is great. And so I have to say I was a bit disappointed, which is we thought this is a blowout sales report. The consensus numbers were not our numbers anyway. We don't provide quarterly sales guidance. So it was somebody else's numbers, and it's not a number that we managed to. I mean, we're basically managing toward consumer takeaway, then it's a view of kind of where we think we'll end the year inventory-wise at our biggest retailers. And that's actually a good story for us. So when you hear about like Black & Decker and Stanley Works and other guys who legitimately, I think, have issues, we don't have any tariff issues. Our biggest import is peat moss, which is exempt from tariffs. We don't have any pressure in this year, or put it this way, so minor that we're not changing our outlook at all. So retailers are trying to look, think about this from a retailer point of view. If everything is costing twice as much and they're trying to protect their balance sheet, and look at like lawn and garden tends to phase into Halloween. Almost all that is Chinese imports. And so what you're seeing is a real opportunity for them to buy less Halloween stuff and extend the lawn and garden season, which is something we really like, because it's kind of artificial where they're getting out in the fall to get set up for their fall business.
Well, let me ask you this. From what I gleaned from your conference call, some of that retail sell-through is being driven by promotions, which you're not paying for, the retailers.
No, we're paying for it.
You are paying for it. I didn't know if the retailers were sort of subsidizing some of that from what I was trying to.
They do.
Okay. So I guess what I'm curious about is if they are feeling the tariff pinch in other areas, are they going to be trying to not offer as many promotions on your products?
No, what's happening right now is retailers coming out of COVID, people bought cabinetry and all the sort of expensive sort of hard goods and barbecue grills, lawnmowers, everything that people bought when they were home. And that's been a big problem. So their customers arriving at retail, is down. So there's a major push for market share and to attract consumers. And so they're very promotionally oriented, so that this is working out sort of fantastic for us. So no, there's no shyness about promotion. Promotion is a very major tool for them to bring customers in the store. I mean, I don't know if you saw that article about Depot in the Wall Street Journal. Their $20 billion secret garden is what they called it. It's one of the biggest categories that they have in the entire chain, and we are the biggest vendor in that category. So our brands are super huge, you know, Ortho, Roundup, Miracle-Gro, Scotts. Right now, we're the biggest vendor in the chain right now. And so lawn and garden good is great for us, and promotion is, I mean, I think all the retailers are trying to get people into the store. And so it's very competitive out there right now.
Jim, let me ask you, we got some economic data this morning. Reports show GDP shrank. To the extent that we see an economic slowdown, there's a lot of smart economists that come on the show, tell me the odds of recession went up. What could all that mean for your business?
Traditionally, that's not much. Remember, our people are homeowners, so they're not the bottom end of the sort of economic scale. So we're dealing with the top sort of people anyway, is people who own their own homes. And so we have not seen a lot of that. And what's happening right now is we, last year, had a 9% increase in consumer takeaway. This year so far, we're talking 14%. During COVID, sales went up over 30%. So this is, I mean, what do we think? Consumers love the garden. What are we doing? We're promoting harder. We're working with the retailers harder to bring customers into the store, and it's working out pretty fantastic. This is why we're a little bit like, you know, we affirm sales guidance, we affirm earnings guidance. We're beating all of our metrics on margin, gross margin up 500 basis points. You know, it's just all these things we've been working on as we kind of are getting out of trouble post-COVID. And I don't know, we thought people would applaud it, and people got stuck on this supposed sales miss when it's not a number that we manage to. We're really managing right now to consumer sales, and as long as inventory right now is, I don't know, maybe sales up, call it 14% today, year to date. Inventory up like maybe 3%. So I think inventory is in really good shape. And a tailwind, which is retailers saying, hey, do you want to do some more stuff in the fall?
Jim, real quick, I want to ask about the cannabis business, which you guys got into, and you've mostly separated it out from your core business here. But I thought it was really striking. You sort of directly addressed President Trump on the conference call, and he said, like, you know, he's obviously been very busy doing a lot of other stuff. You would think maybe he could find some time for this particular measure. What did you say to him, and why is it so important for that business?
Well, he said that he supports rescheduling.
Right.
The biggest issue with the pot business, and it's what's really terrible, this is a business that's bigger than the beer industry. It's bigger than distilled alcohol, okay? So, you know, the legal business alone is north of $40 billion. And the tax rate, because it's federally legal, is a Schedule I narcotic, which makes 0 sense since it's legal in some version or other in every state other than Kansas and Idaho. The tax rate is effectively 80%. You cannot deduct any of your business expenses. So your top line revenue is your taxable income. And so it's gotten to the point where nobody can make money. Anybody who's paying that 280E, that's a section of the IRS code, anybody who's paying that cannot make money. And I think people were willing to put risk capital in before, like 4 or 5 years ago. Today, everybody's been burned. Nobody's putting capital in. The business is in the worst shape ever. That's really what you're seeing on Hawthorne. And we're moving out just because it's not worth the hassle. And I think a lot of our investors we love the lawn and garden business. We love your industry. Why do you gotta have this beta in your stock because of cannabis?
Yep.
But the cannabis business, the president is the only guy, and I've told him this, he's the only guy that can fix this, because what he needs to tell the guy I think was in a hearing in the Senate today, the new DEA chief, is like, you recognize my voice? I made a promise that we're gonna reschedule and we're gonna support it. And you need to do that. And so that's what has to happen, is the DEA has to follow the HHS recommendation, which they have always done, to reschedule, and that solves the tax problem, and then this business can make money again.
Jim, great to see you. Great to have you on this set. Thank you for joining us.
Thank you, guys. Thank you.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings results from Microsoft, Meta, and many more. Stay tuned for Market Domination Overtime.